workers and consumers. What's going to happen if the government puts in place this sales-based formula for allocating corporate income around the world? It's going to mean that you have basically no incentive to utilize subsidiaries in low-tax jurisdictions. Now, I'm a policy wonk. I'm not a practitioner, so I don't know whether Anguilla has a lot of multinational subsidiaries or whether it's just the equivalent of what we would call LLCs in America. But there certainly will be a lot of low-tax jurisdictions and IFCs around the world that in this initial effort will be adversely affected. And when I say initial effort, what do I mean? Well, what I'm talking about is at the beginning, this is going to be going after the big publicly traded companies, or maybe even some of the big privately owned companies. But it's going to go after big companies in the beginning. Now, that will certainly affect places like Cayman. It'll certainly affect places like Ireland. Whether that affects Anguilla, again, I don't know the details about your financial services industry. But they'll start at the beginning with the big companies. But then they're going to move down the list. And sooner or later, they're going to get to the sort of the LLC-type companies and make sure to figure out where does the actual underlying business of this small company registered perhaps in a place like Anguilla, where is that taking place? And then they're going to start arbitrarily imposing tax on the basis of where those sales are or where that income is instead of where the company is being domiciled. So I think this new BEPS report is a huge threat. And what worries me about this BEPS report is that the OECD has gotten very, very clever. It's supposed to be a consensus organization. And when you have a consensus organization, in theory, you can't do things without unanimity. And so who are some of the OECD countries that would obviously be hurt by this? Ireland, Switzerland, Estonia, Luxembourg. There's probably at least 10 OECD countries that would recognize that they would lose out if this type of BEPS regime went into effect. But here's where the OECD is being clever. The G20, theoretically, or not theoretically, the way they're spinning it, the G20 asked the OECD to do this report, and the OECD is going to report back to the G20. So the OECD is going to get around its own internal rules requiring unanimity, and they're just going to take this report. And by the way, I should have given this little bit of background. The OECD put out the report in early February. The Committee on Fiscal Affairs is at their next meeting, which I think is in June. That's when the Committee on Fiscal Affairs is supposed to come up with their recommendations. The Committee on Fiscal Affairs, for those of you who don't follow it, who are they? That's the part of the OECD that does the actual policy making. And who are the CFA, the Committee on Fiscal Affairs? It's a representative of the tax police from every member nation. So when you get the French tax police with the IRS, with Inland Revenue from the UK, you get all these tax collectors in a room together and you tell them, what's your fantasy? They come up with some very bad things. So they're going to come up with some very bad, and of course, it's not that the decisions actually get made by the CFA at this meeting in June. You have the OECD bureaucrats working on it right now, emailing back and forth with the guys at the Treasury Department in the US, with the guys at Inland Revenue in the UK, and they're going to be putting together this package. They're going to unveil this package then in June, but instead of having the OECD vote on it because they know certain member nations would vote against it, they're going to kick it to the G20. And why should that worry us? Because who was it that actually pushed the OECD's original tax competition or anti-tax competition project over the finish line? It wasn't the OECD. It was the G20, because they're the ones that grabbed it and started imposing all these new threats and sanctions. And ultimately, when Switzerland had to knuckle under, that basically was a sign that no longer would the privacy laws in any jurisdictions be a protector for foreign investors. And it was the G20 that made that happen. Who are the G20? That's basically, well, in theory, the 20 most powerful big nations of the world. There are no friends of Anguilla in the G20. There are no friends of Switzerland in the G20. There are no friends of any IFCs in the G20. So there's nobody at the G20 who would be willing to block or stop a very bad report coming out of the Committee on Fiscal Affairs at the OECD. So again, I have no idea what this BEPS project is going to lead to, but if you add 2 + 2, the only answer I think you get to is 4. Now, maybe it won't be 4 right away, but it will be 4 at some point in time, and that 4 is going to be global formula apportionment. Again, it'll start big, but it's going to trickle down, and it's going to trickle down onto Anguilla. And that, I think, right now, I assume most of you are probably worried about FATCA and how you're going to deal with that and the expense and the regulations and the hassle. You have something that you should worry about even more that's coming down the road at you. And so with that, I probably have given a lot of information. I don't want to drone on too long because it's usually the Q&A that's the more interesting parts of these presentations. But I figure talking about Cyprus and the implications for the collapsing welfare state is a big piece of information. The FATCA part was small because there's really nothing good to say about it. But then the BEPS thing is big, and that's new. And so why don't I stop there, and we'll go with Q&A until everyone just gets bored and wants to have lunch. So thank you.
What if in 2016 there's a major shift from the present political leadership in the U.S. to, hypothetically speaking, a Republican leadership? Would this be something that can facilitate change as it relates to FATCA?
Yes, it could, depending on who the Republican is, what they want to make a priority. When Bush was in the White House, as much of a disappointing president he was in terms of government spending, Fannie and Freddie expansions, and all these other things, the one good thing you can say about Bush is that we stymied the OECD anti-tax competition, this first anti-tax competition project, for 8 years. Not because the Bush administration ever explicitly was good on the issue, but just like you can't have OPEC without Saudi Arabia, you can't have a global tax cartel without the U.S. And now that was the OECD initiative. That was multilateral tax cartel. With FATCA, the U.S. is doing a unilateral tax cartel, of course, with the Europeans cheering them on, so it ultimately does become multilateral. Let's say that you get someone like Senator Rubio from Florida or Senator Rand Paul from Kentucky as the Republican nominee in 2016, and they win. So in 2017, you have a Republican president, and unlike Bush, who was more of a big spender, Rubio and Paul are both more small government, Ronald Reagan type Republicans. So I think they'll be philosophically much more, and Rand Paul already has been very active in criticizing FATCA. So if it was Rand Paul, I think you would have someone in the White House who would then be appointing people to Treasury with an explicit goal of trying to preserve fiscal sovereignty around the world. But Senator Rubio, he was very active in trying to fight that interest reporting regulation that the Obama administration ultimately imposed upon U.S. banks. So both of them already have a good track record on some of these tax competition issues. If they get in the White House, and if Republicans hold the House, and if between the 2014 and 2016 elections they win the Senate, then I would actually be, normally I'm a pessimist, then I would actually be somewhat optimistic that we could see some big tax reform changes that perhaps involved an emasculation of FATCA. Because ultimately, I mean, I probably don't need to say this, but for those of you who aren't tax policy wonks, it might be good to emphasize, the only reason we have these fights is not because Anguilla or the Cayman Islands or Switzerland or Singapore is doing something wrong. We have these fights because the U.S. and other big countries are doing something wrong. We're doing something wrong in that we are taxing on an extraterritorial basis. We are doing something wrong in that we are double taxing income that is saved and invested. So if we did something like the flat tax, which again, isn't my ultimate goal, but certainly would be a nice starting point for reform. If we did something like a flat tax, it wouldn't matter whether an American had a bank account in Cayman or a company in Anguilla or whatever, because the U.S. wouldn't be double taxing. So it would be a completely irrelevant distinction anymore. You could have a bank account in Geneva, Illinois, or a bank account in Geneva, Switzerland, and the U.S. As far under the flat tax, we taxed your income once when you first earned it. We're not going to tax it again if you save and invest it. So all these problems that we're talking about in the world would disappear if the high tax countries of the world reformed their tax systems so they weren't so